Understanding liquidity levels proves essential for traders, as these areas denote significant concentrations of orders capable of influencing price direction. They act as effective magnets for market movements. Traders leverage liquidity concepts by marking critical levels on charts to anticipate price action. This proactive approach enables them to strategically position trades and manage risk adeptly amidst market fluctuations. The differentiation between buy-side and sell-side liquidity remains crucial, as it assists traders in pinpointing potential entry and exit points, guided by prevailing market conditions and trends. Buy-side delivery occurs when price movements are orchestrated to engage liquidity situated above equal highs. This often results in trapping traders on both sides, potentially leading to considerable market shifts. Conversely, sell-side delivery encompasses abrupt price movements that target liquidity positioned beneath a cluster of lows. This strategy typically fosters bullish continuations, thereby creating trading opportunities. A comprehensive understanding of swing highs and lows is vital for identifying types of liquidity on charts. These pivotal price turning points enable traders to forecast potential market trends and movements. The underlying psychology associated with swing points significantly impacts traders' decisions regarding stop losses, which are usually placed below swing lows or above swing highs for risk mitigation. This behavior greatly influences market dynamics. The formation of swing lows prior to reaching a demand area can suggest a bullish market movement. This phenomenon indicates that the market is consolidating the necessary liquidity for forthcoming upward trends, a concept crucial for bullish traders. In a bearish context, the development of swing highs that precede a supply zone can signal potential trading opportunities. This pattern supports the notion that the market is gearing up for downward movements, an insight vital for bearish traders. Retail traders frequently anticipate price rejections at significant levels, which informs their long or short positioning. Recognizing this behavioral pattern can enhance strategic trading effectiveness. Smart money often initiates the triggering of stop losses to amass liquidity prior to shifting the price in their intended direction. This tactic underscores the critical importance of timing within trading decisions. Utilizing real chart examples allows traders to visualize key liquidity levels, facilitating the identification of optimal entry points. This analytical process enhances trading strategies and improves overall decision-making. The Euro-dollar 15-minute chart illustrates a robust uptrend characterized by equal lows serving as support, signaling potential points of interest for trading decisions. This technical analysis is indispensable for traders. The intricate relationship between liquidity and market structure is fundamental in smart money trading, as it equips traders with a deeper understanding of market dynamics. This understanding plays a pivotal role in making informed trading decisions. Turning points on charts hold significant relevance for traders, as they denote areas where price shifts direction, often culminating in market reactions. Recognizing these pivotal moments can substantially enhance trading accuracy. Employing Fibonacci retracement levels can yield greater precision in pinpointing potential take-profit levels. This method serves as a complementary strategy that effectively enhances overall trading performance. A thorough comprehension of daily highs and lows can markedly improve trading strategies. These levels frequently attract liquidity and can lead to viable trading opportunities. Traders should closely observe price behavior in proximity to daily high or low levels. Such behavior may indicate potential reversals, thus assisting in the effective planning of trades.